Hello everyone, welcome to Risk Management 102, the most boring but essential part of surviving in financial markets. Now that you know how to protect your capital with stop losses, today we're diving into how to use them to size positions along with setting take profits, calculate risk-reward ratios and unlock the magic of compounding. Remember, this is about building the foundations of a trading or investment plan to approach markets strategically, not just guessing and hoping. Let's get started. I've linked a trading planner spreadsheet in the description, a basic one for anyone to download and follow along and customize if you'd like for your own trades. So please use that. That's what I'll be using over here to do some demonstrations shortly. So we're going to break it down first. Position sizing determines how much capital to enter a position with while keeping risk under control. Remember rule number 1? Never trade or invest more than you can afford to lose. Well, here's rule number 2. Only risk 1% of your portfolio capital per trade. I will demonstrate with a $10,000 portfolio. So that means I will only be risking $100 per trade, which is 1% of 10,000. What does this mean exactly? Having a stop loss lets you buy much more than $100 worth of an asset, as it caps your loss at 1%. And without a stop loss, using rule number 2, your limited position size would be $100. But with one, you can scale up your position sizes safely. To work out 1%, multiply your allocated capital by 0.01, or in the spreadsheet, simply enter your starting capital here. I'm going to go ahead and put 10,000 in. And it will calculate your stop loss for you. Stop loss size 1, risk percentage 1. Now as you get more confident, you can increase this risk percentage and it will automatically increase your stop loss for you. For now we'll be keeping that at 1. I've set up an example Ethereum trade down here with some parameters: entry price, stop loss, take profit 1, take profit 2. We don't know that one yet. So I'm going to show you how with $100 stop loss you can actually enter a position with $500. It's pretty cool, right? Let me show you how that works. Entry price here, 2,500, giving us our $100 entry position size. If you didn't have a stop loss, our stop loss for this example will be 2,000. Now that increases our position size 5-fold, so you can now enter a position size of $500 against the stop loss of $2,000, which means you're only risking 1% of your portfolio. Now let's discuss take profits before I continue on, because this is how we work out the risk reward ratio. Taking profit is about survival. Take profits lock in gains to grow your portfolio steadily, protecting against reversals and lowering downside risk. Chasing the huge wins will drive you nuts and destroy your confidence. Taking small profits along the way secures long-term growth and funds bigger and bigger positions, setting the stage for compounding, which I'll demonstrate shortly. Don't be greedy. Here's a little tip. Markets only trend at 20 to 30% of the time, and the rest of the time they are range bound. So I always set my first take profits at the upper boundary of the high volume nodes, because I'm expecting the range to continue, and I'll set the second take profits for the breakout target, which is the big money target. I set take profits at key levels like high volume nodes, pivot points, Fibonacci extensions, standard deviations. Now let's go back to the sheet. You can enter the take profits here. I use the high volume node ones, 3,600 and 5,000. You don't have to set 2 take profits. This is just how I do it. Everyone has their own risk appetite. You can just take all the profit at 1 if you like, or even add more, take profit 3, etc. I like to scale out 50% at take profit 1, 50% at take profit 2. This helps me manage my emotions best. I can teach you in lesson 103 of the high volume node series to identify take profit areas, and I'll be producing a video soon, methods to identify take profit areas, where I'll look at all of the aforementioned methods. Now, enter your take profit target on the sheet and it calculates your potential profit and risk reward ratio. Here we've got take profit 1, 3,600, take profit 2, 5,000. What's this worked out? Well, your potential profit 1 will be $220. You've only risked $100 to do that. That is a risk reward ratio of 2.2. At take profit 2, $5,000, your potential profit will be $500, and you've still only risked $100 to get there, thus giving you a 5-to-1 ratio, risk reward ratio. Here I've added a little section for me because I take 50-50. This works out the risk reward ratio when you hit both targets at 50%. In this case it's 3.6, so I would make $360 on this trade, only risking $100. So you can see, kind of see how this is coming together and how it's going to work with the compounding, which I'll show you. If risk reward ratios are too low, the position may not be worth entering and you should just move on to another trade. Don't just be chasing it for the sake of it. Let's put all this together and enter some dummy wins and losses to see how the power of compounding grows your account. Einstein called compounding the 8th wonder of the world. It turns small, consistent gains into huge wealth over time. Each win lets you trade bigger while always risking 1% of the new portfolio value. Your stop losses grow, your position size grow, and your portfolio begins to rocket. Each win lets you increase size in your next trade. If your stop gets hit, it's no big deal. You can see your loss has a minimal impact on your portfolio and thus stress levels. Very important. Even a string of losses keeps your account alive, as each time you scale to your new portfolio value, only losing 1%. This is also pretty cool. And now let me demonstrate. So let's say we take this trade here and we hit take profit 1, $220 in our P&L. You can see the current value of the portfolio increases. You can see the size of the stop loss increases, and you can see your position size for the next trade is now increased. Let's say we have another win at take profit 2, 500 on a second trade. Once again, portfolio value increases, stop loss increases, position size increases. You're able to do more each time while it's building confidence, and you have a stop loss hit. In this case we're at 107.2. Well, let's have that. Oh no, I lost a trade. Much less than the wins. Much less of an impact in the wins on your portfolio. Let's say you take another loss there. Your stop loss is now 106.13. And another one. And you can see how a string of losses still keeps your account alive. This is why it's pretty cool. Boring, but pretty cool. And then you have another win. 220, and you're back on track. Another win at 500. Increased position sizes, increased stop loss, another loss, and your account grows, and so on and so forth. One lucky trade might spike your account, but you're likely to lose it again if you don't learn the essentials of risk management. Slow, steady growth builds wealth, confidence and emotional discipline. As you get wealthier, your risk appetite shifts to defend gains, not chase them, and you'll find that makes your account grow even faster. No more panic selling or FOMO-buying because you trust your plan. Okay, boring, but I hope you took that in. There's a lot to cover on the subject, and I'm trying to isolate the basics to get you started. So download the Google Sheet, backtest it with your strategy, share your results in the comments. Next up, I'll cover how to use leverage correctly, the importance of a trade diary, and how to use trailing stop losses. Thanks for watching, and as always, safe trading. Don't forget to subscribe and like. It really helps me out. Thank you.